I'm Spencer Levy, and this is the Weekly Take. On this episode, we're looking at the nuts and bolts of the construction business at a time of uncertainty during the pandemic.
We're taking less speculative risk today, and because of some of the uncertainty in terms of how this plays out relative to demand and underwriting, many of our capital sources are looking to get paid a little something extra for that, or are looking for a value.
That's Mark Wilsmann of MetLife, a company with more than a century of investing in skyline-defining projects and one of the most prominent financiers in the global commercial real estate business.
We are indeed doing some things different today. We have a new project that's under construction, and we have decided to kind of take some actions that relate to what I would call a healthier building.
And that's Matt Khourie of the Trammell Crow Company, the largest commercial real estate developer in the United States. Two big builders and partners in construction breaking ground on one big question. Was construction built to survive this pandemic? That's right now on the Weekly Take. Welcome to the Weekly Take. I'm delighted to be joined by two real estate veterans and friends of mine that I've known for over a decade. Matt Khourie, CEO of Trammell Crow Company, calling in from Pebble Beach, California, and Mark Wilsmann, Managing Director and Head of Real Estate Equity at MetLife, joining us from his home in Short Hills, New Jersey. Matt and Mark, welcome.
Thank you.
Thanks, Spencer. Great to be here.
Great to have you guys. So, gentlemen, not a lot of our listeners know exactly what Trammell Crow Companies do and what MetLife in real estate does. So, Matt, maybe you can lead us off and tell us what Trammell Crow Companies does.
Sure. We are ground-up developers of all types of commercial space, but primarily industrial, multifamily, and office. Those would be our kind of three basic food groups. And then we do some other product types I would call more niche. We're active in 16 major U.S. markets, focusing on the larger markets in the United States, plus London. We've got $15 billion of developments underway today, and roughly $4 billion of developments in our pipeline. And I'm really glad to be on this with Mark, because Mark is one of our most important and biggest partners, and we do a lot of business with institutional capital partners, just like MetLife.
Well, Matt, that's a great transition to Mark. We'd love to hear a little bit more about what MetLife does on the real estate side.
Sure. So we invest on behalf of the MetLife Insurance Company, as well as other institutional investors like sovereign wealth funds and pension funds, et cetera. We have a little over $30 billion of assets under management. An interesting thing about MetLife, which is a 150-year-old insurance company, is that we've been investing in real estate development for well over 100 years. Some of our earlier notable investments were financing the construction of the Empire State Building and Rockefeller Center as examples. So we invest really for the long term. We've been working as an organization, working with Trammell Crow for over 50 years. And of course, Matt and I have been working together shorter than that, but still have done a lot together over the last decade or two. The
general question is, why construction? It's the riskier end of the real estate spectrum, generally speaking.
So we really see investment and development as, again, a way to access high quality assets at a cost basis that is less than usually what you would have to pay to buy something existing. So you're certainly taking some market risk, but we have been able to do it in such a way that we manage our exposure to market risk so that we're not ever biting off more than we would want to at a given point in time.
I'm going to now shift to the right here, right now, shorter term. We're in the midst of the COVID-19 crisis. How does that change your point of view towards construction development risk today, Mark?
Well, certainly we're taking less speculative risk today. And because of some of the uncertainty in terms of how this plays out relative to demand and underwriting, many of our capital sources are looking to get paid a little something extra for that, or are looking for a value proposition today. So certainly it's impacting the new starts today. There continues to be extremely strong demand for industrial, and industrial development is going to continue to occur. Certainly both, pre-lease, there are a lot of pre-leased opportunities today, and then there are also some speculative opportunities that actually make sense. We also think that longer term that we're still underserved in housing, and multifamily still makes a lot of sense. I think there's a lot of uncertainty with the office sector in terms of how things play out. We are not negative on the office sector, but I think there's a lot of uncertainty. And for that reason, I don't see us investing in a speculative office deal in the short run until we see how this plays out.
Well, Matt, same question to you. What has changed in the short term from Trammell Crow's point of view towards construction?
Yeah, well, let me talk about the very, very short term, Spencer, and that is we had some issues in March and April relative to the shelter-in-place orders that were in most parts of the country. So as a kind of ground-up developer, we had to stop construction in some of our markets because the governmental authorities basically said, hey, until we lift these restrictions, there's going to be no commercial construction. It didn't kind of comply with policy. So we took a hit in some markets. Seattle comes to mind, Pennsylvania comes to mind, a few others. Fortunately, since then, construction is basically back in full swing. I'd say we're 90% plus operational on all of our developments underway. So I guess that's good news. We're a bit concerned, obviously, if there's further shelter-in-place restrictions, if they come back, second wave, et cetera, could impact us. As it relates to product types, pretty much in sync with Mark on that. And Mark and I talk a lot about this, by the way, is we had a lot of deals working in each of the food groups, but industrial has gotten through this COVID-induced recession very well overall, so it's almost in a category by itself. Multifamily, agree with Mark that it's a good solid product type. There's going to be an impact, and values are likely to go down, rents are likely to go down, but I think overall they'll recover fairly quickly. So we're still actively looking at compelling new multifamily. Now, as it relates to office, we'll still do some office, but it's primarily going to be build-to-suit office or heavily pre-leased office.
I'll take it one step further. Have you made any changes in the design of buildings because of the COVID crisis for wellness or otherwise?
It's evolving. We are indeed doing some things different today. I think of a project that we're doing now in Seattle, where we have a new project that's under construction, and we have decided to kind of take some actions that relate to what I would call a healthier building. And some of the things that we're either doing or considering doing on the project, just to give you a flavor for how we're addressing some changes, is air circulation and using outside air. We're going to be using 100% outside air on that project in downtown Seattle, not going to be recycling air. We think that's a healthier approach. In our air duct system, we're going to have some ultraviolet lights in the return air area that kind of disinfect and kills various pathogens. We think that's a kind of a smart approach to this. And then there's a whole technology developing now. It already had started, but it's going into overdrive on touchless everything. So touchless doors, and that's not just the main entry doors, that's the garage lobby doors, that's restroom doors. All of those become touchless and probably effectuated by kind of a mobile phone device. We're moving towards 100% touchless restrooms. We're doing things on elevators. Elevators can be a kind of a hot spot, so elevator cab purification systems are kind of in process there. Mobile app call features for elevators so that you don't have to touch an elevator button. I'd say the last thing we're thinking about is some kind of infrared temperature taking devices at building entries so that if necessary, we can make sure everybody who comes in is in kind of the right bracket of body temperature. So those are some of the things. It'll be interesting to see how they evolve, but I think to be able to lease office space in the future, you're going to have to address the safety issue big time.
I was just going to add, we've been actually very pleasantly surprised that the projects that we have underway have really been very minimally impacted, as most, really all of them have been, deemed essential work. And the other thing I just mentioned is that I've been very impressed with how sophisticated the contractors have become, really very early on in terms of screening people, coming onto the site, health questionnaires, temperature screening, getting a little bracelet that entitles them to work on the site for the day, and then the social distancing that occurs. Certainly outdoors it's easier. Indoors, wearing masks and other protective equipment. That was instituted, very early on in this process, and in many ways, kind of as a forerunner to what we're seeing now with opening office worker space.
The general contracting industry has really responded well. We've got over 100 projects under development around the country, and very few of those have had any kind of COVID outbreaks, shutdowns, et cetera, which is to me amazing. I thought that would be a big issue for us, but so far so good. Obviously we'll have to see how that plans out, but they have done a masterful job, the GC business.
Well, let me dig into two aspects of that. One is short-term costs associated with different procedures on the job site, and the second is long-term costs with changing your building systems. How are those costs being addressed? And I'll start with you, Mark, and I'll harken back to a conversation I think you and I had 10 years ago, talking about changes that needed to be made for sustainability purposes, and the investment case wasn't made yet. Today, I think it has been made for sustainability. Is the case black and white now being made for wellness in the short and long term?
I think it is, and interestingly, it's easier and less expensive to incorporate features into buildings at the time you're developing them than retrofitting existing properties. But I think that more and more major tenants have been focused on everything in ESG, and health and wellness certainly at the top of the list. And right behind that is sort of, how your building, in essence, is contributing to the community around it. And it's easiest to make those enhancements and to make those changes and most cost effective at the time that you're developing.
Well, I know that change orders are the bane of the existence. How do you deal with those types of change orders? Starting with you, Matt.
Yeah, there have been some cost implications. Interestingly, though, it hasn't been runaway cost implications. We have healthy contingencies in our budgets, and we haven't seen any of those short-term costs eat up all of our contingency in pretty much any project. So yeah, it's going to be more expensive. The delay actually is oftentimes more expensive. So added interest costs from your construction lender, et cetera, not being at 100% efficiency. The cost related to having kind of COVID procedures on the sites isn't that material, I'd say, in the scheme of at least our projects. Talking about some of the costs on just making a healthy building, so the long-term costs, I have been kind of monitoring that Seattle CBD building I mentioned earlier and all those initiatives there. And we just think the total of all those initiatives may add about 1% to the total project cost. So a lot less than you'd probably think. And again, manageable. So far, we're not having a lot of budget bust related to the either short-term or long-term cost issues.
I would just add that the two large office buildings that we have underway are both, substantially pre-leased, and the tenants have asked for some modifications, and they're paying for those modifications. So it isn't always the developers or the landlords' nickel. And the other thing that Matt just touched on that is a benefit with this situation is that, of course, LIBOR has come down significantly, and our interest costs have come down, related to that. So that has helped make up some of the difference.
And Mark, you're actually, MetLife wears a lot of hats. You're on the equity side, and we have the debt side. Any additional color you can give on whether you're the borrower or the lender in situations that you've had to deal with over the last 3 months?
Yeah, certainly in the construction loan market, the large banks have pulled back over the past few months, and they've been very, very big in supplying some of the relief to the broader economy in terms of the CARES Act and the PPP. And on smaller projects, smaller development projects with more regional banks, that is a much more liquid part of the market today. putting together a syndication of banks to do a big deal is very difficult today. But if you're in a smaller situation dealing with regional banks, it's actually quite liquid.
Let's shift now and talk a little bit about markets. And I know you've done many projects together. So let's talk about a project you did a couple of years ago in Dallas, the Park District deal. Mark, tell me a little bit about that deal, and has your point of view changed on CBD versus suburbs?
Really, since the global financial crisis, we've been directing a lot of our investment in what we believe are sort of the growing, demographically attractive sort of next tier markets. And so those are, the Seattles, the Denvers, the Dallas, the Austin, the Charlotte, the Nashville, Atlanta type markets. Our view is that the aftermath of COVID is going to make those markets even more attractive going forward. So, I do think that the big cities are going to recover. I think that people are social animals, and they're going to be attracted to everything that big cities provide again, once they feel safe. But if you look at quality of life, cost of living, lower tax burden, and certainly the easier ability, at least at the margin, to kind of get around some of these smaller next tier cities, we think that they're going to continue to be the beneficiary of movement out of California, out of the Northeast, and good markets to invest in front of. In terms of the question of CBD versus suburban, I think in the short run this is going to create an interest in suburban space, but I think that it isn't going to significantly change our view, at least as it relates to suburban office, for example, in places like Chicago or the Metro New York area. We think that's going to be maybe an attractive short-term play, but longer term, we like these growing cities.
Matt, what's your point of view?
Yeah, well, I'll start with the Park District deal. And the reason I like that deal is it's a mixed-use project and right on an urban park. Our mantra is the best site in the best submarket. We gravitate towards those, even if we have to pay more for the dirt. And I would say that applies either in a CBD setting or in a suburban setting. I'm not a big believer, I may differ from Mark a little bit on this, I'm not a big believer that this is going to really change in the midterm or long term the dynamics of suburban versus CBD. If we go suburban, which occasionally we do, we're going to try to go in an environment that's kind of a work, live, play environment where there's a lot of amenities. You're probably next to some kind of transit center, and it's almost an urban/suburban location.
But has transit-oriented development gotten less valuable today because of COVID?
Yeah, in my mind, I don't think so. I think that there's always value to being able to provide multiple modes of getting around. And the younger generation, many folks have no interest in owning a car. And so I think it's always an advantage to be close to transit. Our research group a year or two ago did a study in San Francisco and basically showing sort of the relative cost of using a rideshare service, a pooled rideshare service versus public transportation, and then comparing that to being, the higher expense of renting an apartment next to a transit location versus a more outlying location. But I think in most cities around the U.S., there's still a great advantage to being close to transit.
Yeah, I'm with Mark on this one. I think that obviously going to take somewhat of a pause, will be less over the next 6-8 months, but I just think it's temporary, and folks will get back on mass transit again in the same numbers that they used to. It's less costly for those commuters to go on transit than it is to use a car and drive on a freeway and pay a bunch of gas. And the amenity cluster, Mark mentioned it a little bit earlier, that is a pretty compelling lifestyle situation too.
So let me ask one more construction question. So a lot of times the United States is a leader in certain things in commercial real estate. Sometimes it's a laggard. And one of the areas where I think we are a laggard is some of the green technologies that are used in Europe to build buildings. And these are things using natural building materials or modular construction. Do you see some of those construction techniques from Europe, green or otherwise, coming here? And some of them, like modular, might be cheaper. Matt, what do you think?
Well, let's divide it between those two. I'd say as it relates to sustainable buildings, and as I said, we've bought a multifamily developer in London, and I was really surprised to see how committed and how much effort they spend on sustainable building and kind of the ESG area. So yeah, absolutely, Europe is leading the charge on that, primarily because a lot of the big pension funds over there, the Dutch funds and others, just demand it. They say, hey, we're not going to invest in a new project unless it ticks all these boxes. So they're much more adamant about that than I would say the pension funds over here in the U.S. So that's helped drive that sustainability evolution there. I do think that that's going to migrate over here over time because it's the right thing to do, and we at Trammell Crow committed to sustainability. And it's probably going to continue to lag a bit to Europe, but it's ultimately going to get over here in a similar fashion with maybe a 2-3 year delay. Relative to modular, I've never been a big proponent of modular. I've been hearing about modular and how it was going to be a game changer literally for my entire career, 40 years in the development business. And it has just not really taken off in any, I would say, kind of more upscale commercial developments. In Europe, yeah, you see it. I'm not a believer, at least thus far, that modular construction is going to be a game changer over here. If it's proven it's effective, I could change my mind, but right now, I just think it's overhyped.
Mark, similar question I just asked Matt, which is, look, MetLife is not just a U.S. investor. You're a global investor. You're a global lender. What are some of the global trends you might have been seeing in some of your lending in Australia or in Mexico, where I'm friends with many of your colleagues down there as well, that think might be instructive and might be coming here?
Well, that's a great question. I think in a lot of cases, and ESG is probably the notable exception where the U.S. really lags Europe. But I think in a lot of areas of technology and building design, I think the U.S. is a relative leader. And when I travel outside the U.S., I often get asked about things that we're doing here in the U.S. One that has been talked about a lot is sort of multi-story industrial, which is something that, for example, is very common in Japan, but really hasn't been executed in any significant way successfully in the U.S. And there's some reasons for that, mostly because we like big trucks and we like a lot of space, and we're just not, used to dealing in smaller, more compact kind of environments. But I think overall, the U.S. is a leader in technology, and oftentimes I get asked about what we're doing in the U.S. and the application outside the U.S.
Let me wrap up this with a mentoring question, because all of us have been in this business a while. We all got a few gray hairs. But there are many of the younger professionals in our business who don't. This is their first downturn. And quite candidly, many of them are scared. Matt, what advice would you give younger professionals about how to cope through this crisis and how it might compare to prior ones?
Good question. We have continued to hire young people into our business despite this environment. And the reason is you get into the real estate business for the long term, not the short term or the medium term. It's as they say, it's a marathon, not a sprint. So the advice I would give young people is be resilient. You're going to take some body blows during this cycle. You're going to work on a lot of problems. I mean, there's going to be some tough stuff to have to get through, but be resilient. Feel confident that you're going to get to the other side of this. And also, to the extent you can do a really good job on the really tough assignments that aren't fun, that will separate you from the pack. Because I know as we look at promoting folks at Trammell Crow, those folks that have taken on the toughest assignments that aren't exactly fun, if you do a good job on those, you're going to have a more favorable career path than the folks that kind of veered away from that.
And Mark, same question to you. What advice would you give younger professionals who are dealing with a crisis for the first time?
Well, I think this is just a wonderful learning environment. I think the most valuable lessons I learned have been in times of challenge, not in times where literally anything you touch, works out because the market is strong and the tide is raising all boats. Don't get distressed. Change creates opportunity. This is a long-term business and a long-term asset class. There's certainly lessons learned when times are better in terms of managing how far you get over your skis, how far you push leverage, how far you test markets that are unproven, et cetera, because those are usually the circumstances that cause you to endure the biggest challenges when things soften. We're going to come out of this. There's no doubt in my mind. And I think there will be some lasting changes, but I think that a lot of the fundamental things that make the real estate business successful are going to still be there when we get through this.
Well, those are words to live by. A lot of the things that made the business successful will be there once we're past this crisis, and I agree with that completely. So on behalf of the Weekly Take, Mark Wilsmann, Matt Khourie, thank you for joining us.
Thanks.
All right, thanks, Spencer.
For more information, go to CBRE/The Weekly Take. Until next time, I'm Spencer Levy. Be smart, be safe, be well.